Hey gang, it's Friday, July 31st, and I wanted to do a quick video about, well, you guessed it, because what's up on the screen, Apple earnings. Apple announced earnings yesterday, and to the surprise of no one, they beat yet again, and it seems like the stock is reacting pretty well today. It's up about $27 or 7% pre-market, which is crazy considering the company already has a market cap of $1.6.7 trillion. So add another couple hundred billion to that, or a couple 10 billion to that. I don't know what the math works out to be. Probably less than a couple hundred billion, but it's still quite a lot. You're basically adding a Fortune 500 company to the market cap in just one day. And that's pretty impressive. On top of that, they announced a 4-for-1 stock split. So I want to talk about what that means for investors and why they're doing it, because they've done it in the past. And then I also want to dive into the details of the earnings to see if they're really good and whether or not the stock is overpriced. I do own Apple stock, so I'm benefiting from these jumps and the pricing that's happened in the last year or two. I mean, you can kind of see that just a year ago, the stock was at $197. Maybe a bit more than a year ago, but it's basically doubled in 1 year. So the return has been crazy. And I remember buying the stock back in 2016, where people were kind of writing it off as a dying company. Sometimes that happens. A company kind of stalls out for a bit, and then things start improving. Multiples start expanding as people start liking the company again, and the pricing shoots up. So if you were buying Apple in the $90 range, even though it was well below that before, you're basically quadrupled your money since then, even ignoring the small dividend that they pay out. So it's been a very good investment, and it seems to continue to be a good investment, as they've really done a good job of introducing new products, growing their services business, and continuing to iterate, even though there's small iterations on their phone, and continue to make money off of that. So let's take a look at the earnings. The press release is right here on the apple.com website. I'll link it in the description below. But essentially, they're up 11% in terms of revenue from the year ago quarter, which is amazing considering, hey, there was no pandemic last year. There's a pandemic this year. And sure, they probably benefited from some of the free money, or I won't say free money, some of the money that the government sent out to battle that pandemic, and some of the fiscal stimulus that went out. But it's still very impressive to see that happen in a quarter that was mostly impacted by the pandemic. It's March through June. A lot of this stuff was already happening at the end of March. It certainly was happening in April. End of March, sorry, through June. So April, May, June, right in the heart of the shutdowns, they still made $60 billion in revenue. They still made $2.50 in earnings per share, up 18% on the earnings side, 11% on the revenue side. Very, very impressive. Big growth in products and services. And $16.3 billion in operating cash flow. That is just amazing. Apple just makes so much money from their products and services that it just, 16.3 billion is more than the revenue of a lot of Fortune 500 companies. And this is just pure operating cash flow. They make so much money. It's not a surprise that the stock is just growing so much, because Apple at this point is like, it's just printing money. It's like a bond. The revenue is great. The earnings or margins are great, and people just, since they have no options to put anywhere else in the market, savings accounts give you nothing, bonds give you nothing. Apple has become like the safety net for a lot of people, where a lot of their money just says, hey, if I have to invest in the stock market, I want to invest it in something safe. And Apple just seems safe. They've continued to hit it out of the ballpark every darn quarter, and this quarter is no different. Despite the pandemic, these guys are blowing estimates out of the water. I think the estimates were somewhere in the 51, 52 billion range for revenue. They hit 59. It's crazy. It's just crazy. They do pay a dividend. They declare the cash dividend of 82 cents. And on top of that, they approved a 4-for-1 stock split. Last time they did that was a couple of years ago, when they did a 7-for-1 when the stock was trading at 600 plus. Now it's trading at 400 plus. And, their goal in the long run has always has always been to kind of get that into that $100 range with those stock splits so more people can potentially afford to buy the stock. And in general, the market has responded well to that, as can be seen by the pre-market boost. The idea behind the stock split is if you're a small investor, a $400 stock may seem like it's just too expensive for you to buy, even though it doesn't really matter. It doesn't change the value of the company. But at $100, you may jump in, and that can sometimes boost the value of the company, even though it doesn't really change anything. And I'll talk about what that means in a second. But let's just take a look at the statement of operations, the actual sales. The breakdown of the revenue is pretty impressive too. $46 billion in products, $13 billion in services already. I remember when services was a couple billion a quarter. Now it's 13 billion in one quarter. I mean, if you think about what that means, Netflix, a very popular company that's 200 billion plus in market cap on its own, had I think 6 billion in revenue in the latest quarter. So services has double the revenue in a quarter of Netflix, that a company that everybody knows, that a lot of people love to invest in. I have shares in Netflix as well. It's done well for me, but services on its own has double the revenue. So we're talking about a 50 billion revenue area of the company that's just services. That's App Store, Apple Music, Apple Arcade, Apple News. I'm probably forgetting some other Apple stuff that makes up a majority of that. Apple Pay, Apple Cash, whatever stuff they have. Apple Care Plus, when you buy a phone, you can buy insurance on your phone for $99 or $199 or whatever it costs. All of that stuff rolls up into services, and that's a high gross margin business. They're making pretty good money off of this 13 billion in revenue. Look at the product. They have 46 billion in revenue, but 32 billion of that is cost. So still a pretty good margin, probably in the 30% range. But services, they have 13 billion in revenue, and only 4 billion of that is cost. So margins are in the 60 to 70% range. And I think they probably talk about that in the release too, because it is pretty impressive. Maybe they don't. But it's a high margin business. Revenue is growing from 11 billion last year, 11.5 to 13.1 this year. In the 9-month period, it's gone from 33 to 39. Very impressive business model there. Earnings per share are up. Shares are down as they keep buying back shares. So not only is net income up from 10 to 11.2, but your number of shares are down by about 200,000. Your earnings per share go up by a combination of the two. America still their number one sales area from a geographic perspective. But again, Europe's up, China's up, Japan's up, rest of Asia Pacific is up, everything is up. This was just a blowout quarter by any means. iPhone is up. The iPhone 11 still doing well, but they also released the iPhone SE, which I really like. I actually have an iPhone SE myself, but I have the original one, the one that came out like 5 or 6 years ago, or however long ago that was. Maybe it's 4 years ago. I'm the type of person to use my phone until it dies, and this one still works, so I don't plan to update anytime soon unless this one dies. But maybe it'll be the iPhone SE because it's much cheaper than the standard model. But that's a way for them to release a product that has a much lower entry price and put people on their platform, knowing that even though they're making less money on the phone, that person who's now on their platform, who might have been on a Google phone or a Android phone that's much cheaper than a standard iPhone, can now be part of the services product offering. They can get Apple Music, they can use the App Store, they can improve their revenue on the services side where they make more margin anyway. So whatever they lose on the smaller priced phone, they make up on the services side of things. And that is a good business model. And really it started with the iPhone SE, and they saw it working, and they've continued to do that. And iterate on that product line. And I think they'll do that more because they really know that services is the path forward. They're going to make a lot of money from services. Their margins there are better. The phone space is getting more competitive, but the iPhone's still doing great on the higher end of the scale as well. It's still one of the best selling phones in the world. It's probably the best business model that has ever existed as far as the iPhone goes, because that's, it's $1,000 product with good margins that people just buy almost every single year, even though the iterations are relatively small. So they continue to make a ton of money off the thing. But now they're also kind of diversifying into these other areas. The wearables area is now a $6.5 billion a quarter business. This is your Apple Home, your Apple Watch and all of that stuff, Beats headphones that they bought a couple years ago, the iPad, again, up quarter over quarter, the iMac up quite a bit quarter over quarter, services up quite a bit. So overall, just really, really impressive earnings. I can see why the stock is responding the way it is. And I mean, if you look at the company, it's 1.67 trillion, probably closer to 1.8 trillion now once it opens this morning. On top of that, they have $190 billion in just cash and marketable securities. It's just really impressive. The safety net is there for this company, even if they weren't doing well right now through the pandemic. Even though they're still generating a ton of cash, which is crazy during this time as a tech company, an electronic company. They have $190 billion, and yeah, they have $94 billion in debt, so maybe it's $100 billion in net cash. It's still quite impressive. There's a safety net. You can see their cash statements here, tons of net income, $60 billion in cash generated by operating activities in the 9 months ended, where they spending maybe $7-8 billion on capex. So we're talking about $40-50 billion in cash flow. And there's a dividend there. There's 10. And they're using some money to repay debt. They're using a lot of money to buy back stock. So their cash total is slightly decreasing, but it's still real good use of their money. These guys have been buying stock for a while now, and if you look at their stock price, it's clearly been the right move. And if they think that the stock market's going to reward the company more, all of the purchases they've made in the last couple of years have really served to drive down the number of shares, which is good for investors at the end of the day. At the end of June 29th, there were about 4.6 billion outstanding shares. Now there's 4.35 billion outstanding shares, which is, if you own Apple, you own a larger share of the pie, of the earnings pie now, which is good for you. Price-wise, is the company overvalued? The market has rewarded the company pretty fairly at $384.76. It's hard to tell because I don't have the annual earnings per share here, but earnings in the 9 months ended from June 27th to June 29th, they're up what? They're up $1.30, $1.40. So maybe they're up 14-15%. The stock price since June 19th, like I said, is basically doubled. So you're talking about mostly expansion of the multiple that's driving the price. It's not the earnings haven't doubled, it's that the price has expanded. And that's because the market multiples have also expanded. People have valued stocks more richly in the last year or so, simply because the alternatives aren't there. Bonds are basically paying zero. Savings account are basically paying zero. The money supply has increased quite a bit, which I've talked about in previous videos, and the multiple has expanded. So is Apple potentially more risky now than it was in 2019, even though the earnings are better? Yes, because the multiple has expanded so much. You probably, back here in the $90 range, their earnings weren't that bad. They certainly weren't 4 times less. You probably could get Apple at a PE in the low teens, 10, 11, 12, something like that. Now you're paying 30 plus for each dollar of earnings, because their earnings are, not that much higher than they were in 2016. They're still growing, but they're not growing at a 100% per year pace, which is what the stock market has grown at. The stock price has grown at, rather. So there's certainly more risk now, but it's still an amazing company, and I see why people invest in it, and that's why I'm invested in it. So love it. Still continue to hold it. If there's any dips, I wish I bought more here, but really I was buying other stuff at the time. I think I did buy some Apple in my M1 accounts that I track on this channel, but not a ton. But I also own it in another account where I just own standard shares of Apple on its own that I bought, 2016. And again, I wish I bought more at that time, but can't look back and think about things you could have done. You just look at things you did, and I still bought a decent amount, and I have it. So good to be an Apple holder, continue to be an Apple holder, and I think the company still has some good runway ahead of it, because some of these other areas are growing at a good pace, and iPhone is going to continue to be a solid moneymaker for the company through the years to come. I don't see anything changing anytime soon. So now we get into the let me get rid of this margin stuff. And this is kind of just what I talked about. Company margin was 38%. Products gross margin was 30%. Services gross margin was 68%. So 68% gross margin on a $13 billion quarter business. I love it. So there's a 4-for-1 stock split happening in August. The dividend is also being paid out before that happens in August. So what does that mean for an investor? So let's say you hold 50 shares of Apple today. The price before market open, it's going to go up, is about $385. I round it to make it simple. If you hold 50 shares at $385, your value is $19,250. Your dividend that you get per share per quarter is 82 cents. So you get $41 in dividends. So all a 4-for-1 stock split does is it changes the number of shares on offer without changing the value of the company. So basically what that means is that for every share of Apple you own, you're going to get 3 extra shares. So now instead of owning 1 share, you're going to own 4 shares of Apple stock. So your 50 shares become 200 shares. The price doesn't stay at $385. Obviously, we're not creating free money here, because now there's 4 more shares, or there's 4 times as many shares offered as there are today. The price essentially drops in order of magnitude. So the price today is $385 because there's an increase in the number of shares offered without a change of the market capitalization of the company. The price becomes $96.25, just $385 divided by 4. Your value doesn't change, so you own 200 shares at a lower price. The value is exactly the same. The dividend also gets cut because the dividends, again, are paid out per share. It's 82 cents per share. Since there's more shares out there, the dividend reduces to account for the new number of shares that are out there. Becomes 20.5 cents per share. Again, you're getting $41 per quarter for your 200 shares. So nothing really changes. The value of the company doesn't change. The amount of dividends you get doesn't change. The price does drop to account for the fact that there are more shares out there, and you do get more shares of the company. So what's good about this for investors? Well, the thinking is that, hey, a lower share price might attract a different class of investors and might help boost the price because of more demand for the stock. There is some truth to that, probably. If you look at a company like Amazon trading at, $3,000 at this point, which is ridiculous. Some people just can't afford a share of Amazon because it costs $3,000. They can use websites like M1 Finance, but obviously to buy fractional shares, or I think Fidelity does fractional shares now, and Schwab might do fractional shares. A lot of people are getting into the fractional share game, but if you're not in that world yet, and I spelled dividend wrong here, fixed it. If you're not in the fractional share game yet, you just can't afford Amazon. So it's possible that the thinking applies to Apple as well. A $385, 400 plus after today price might mean that you just, if you have $100 to invest, $150 to invest, you can't even buy 1 share. So you buy something else. Now that the stock is split and the price is back into that $100 range that they like to keep it in, they split 7-for-1 when it was in the 600 plus range to get it under 100. Now they're splitting 4-for-1 to get it under 100 again. It's going to be over 100 after today's blowout earnings, or last night's blowout earnings. But the idea is that more people are going to be able to invest in the stock, potentially drive up the valuation again, and just attract a new class of investors. So that's why the split's there. From an investor's perspective, I don't mind it. It looks the same as far as the total amount that I own. I get the same dividend as I got before, but I just have slightly more shares than I used to. And if it drives up the price, the actual valuation of the company in the long term, then hey, I'm on board. And since the company is really executing on all cylinders and continues to do so, Tim Cook's really been a great CEO. The expansion of services, the growth of wearables, the growth of the return to growth in iPad, really the growth in iMac, the continued, I don't want to say dominance, but the continued presence of iPhone and the amount of revenue it generates is still there. There was some negative news in the earnings. The new phone might be delayed a bit, not a ton. It's still going to come out. It's still going to probably be a hit, but it is delayed a bit, obviously because of the current economic climate. Things are just being impacted by that, and the shutdowns that we had, and the loss of productivity that happened because of that. And then, there's also the economic outlook. Sure, this quarter was really good. A lot of that was fiscal stimulus flowing into people's pockets, that $1,200 per person check or deposit that people got. Some of that might have gone into the electronics space. Some of that might have benefited Apple. What's going to happen when that's not around? What's going to happen when the economy kind of continues to chug along at a rather less than stellar pace? Is the next quarter going to be as good as this one? Is the quarter after that going to be as good as this one? Will the unemployment numbers finally catch up to what's essentially it's not a necessity. If you have a phone and the new iPhone 12 comes out, you don't need an iPhone 12, right? You don't need a new Macintosh. You don't need a new iPad. You don't need the new Apple Watch. It's not a necessity. If I'm struggling, as a lot of people are these days, and their unemployment benefits are about to run out, and they're struggling to make ends meet, they're certainly not thinking about buying a new iPhone. And that could be the story in the next earnings, or the earnings after that some of this growth, some of this expansion of multiples just kind of slows down a bit. If the multiple shrinks, the price could come down. If the earnings stall or start to shrink because people aren't spending as much money on luxury goods, and honestly, the iPhone, like I said, is obviously a luxury good, then the multiple and the earnings come down, and the price could go down quite a bit. So things are somewhat expensive by conventional metrics in the market, and Apple is no different. But you have to kind of also think about there's a lot more money supply in the system and a lot more money flowing into stocks. And Apple is one of the best of breed when it comes to stocks, in terms of being consistent, in terms of having good margins, in terms of doing well, and in terms of being a beneficiary of the multiple expansion, where I still feel good about that multiple being a reflection of the safety of the stock in relation to some other stocks that have gotten a equivalent multiple expansion. I mean, this is a company that has made money, and a lot of money, for years, ever since the iPhone and the iPod came out, and they've really improved upon the iPhone, continued to make it better, continued to improve their margins, introduce new products, and they're still very, very dependent on the iPhone as far as their revenue goes. You're talking about 26 billion out of 59 billion, but that's a lot less than it used to be. And that's what the market wanted out of the company. They wanted the company to diversify away from just being a completely iPhone dependent company. And they've done that. They're still certainly iPhone dependent, and if something happens to the iPhone, this company will suffer. But I don't see that happening, because people are so caught up in the Apple ecosystem now. They have an iPhone, they have an iMac, they have an iPad, they have an Apple Watch, and once you're a customer, you're using their services. I have one of those things. I have an iPhone, which is the cheapest iPhone they offer, and my wife has an iPhone, but both of us have an Apple Music subscription, so I'm part of the services business. I rarely use the App Store for anything because I'm frugal and I don't want to spend money. And when I do get my Apple Music subscription, I make sure to get my Apple gift card from Costco when it's on sale. So I pay like $79 or $89 or however cheap it is for 1 year's worth of subscription. So I think the value is good. But a lot of people are using the App Store. A lot of people are subscribed to Apple TV Plus, even though that service still has a long ways to go. There's potential in it, right? Apple Arcade, probably not a huge hit, but there's potential in it. Apple News, probably not a huge hit, but there's potential in it. They have a lot of services that they're trying to diversify into in order to grow the services business because they know they don't want to be dependent on the iPhone. They know they don't want to be dependent on a certain product category. They want to do something and have something that diversifies them away. And services does that, right? Services are going to be relatively reoccurring, and they could certainly drop if there's an economic slowdown that's big. People are going to stop buying so much stuff on the App Store. People are going to cancel certain subscriptions, and services could drop. And that's obviously the risk with Apple. As a luxury-ish company, they are going to be impacted by any economic moves. So far, that hasn't happened. Will it happen in the future? Potentially, but if it does, it'll probably bounce back. And Apple, more than any other company, is well positioned to weather any storms that come. After all, they have so much cash. They have the ability to kind of adjust their product production as demand wanes and ebbs and flows, and then bump it up as it increases. And they have the ability to kind of take a lot of the stuff that they've been doing externally in-house too to improve margins too. Recently, Intel made some of their chips. They're not doing that anymore. Apple's taking it in-house, and they're probably going to do more of that as the company becomes bigger. And they have so much cash that they can afford to just buy a bunch of smaller companies, invest in other technology. I'm sure there's more stuff coming to Apple in the next decade, and I'm still excited to be a shareholder. Short term, who knows what's going to happen? A lot of economic issues out there, but long term, I'm long Apple. I own Apple. I'll continue to hold Apple. In my index funds, S&P 500, etc. Apple's the biggest company in the world right now, so everybody owns some of it if they own an index fund, and I probably own more than my share of Apple in the various index funds, plus my individual holdings, plus my M1 Finance holdings. So big fan of Apple. Earnings pretty great. Stock split pretty good. And Tim Cook, keep doing what you're doing. And I look forward to see what happens to Apple in the future. But hopefully you got something out of this video. I think I'll do more of these like earnings, stock analysis type videos in the future. Hopefully you enjoyed them. If you did, let me know what you think. If you want more of any specific company analysis, let me know what you think. Again, I'm not doing this to really dive into the details and do some boring spreadsheet stuff, although I do enjoy some spreadsheet stuff, so I'll do some like I did with the stock split. But I just want to do a high-level overview, tell you what I think about the company and where I think it's going. As always, talk to a qualified investment advisor before you make any decisions. I am long all of the companies I have discussed in this video. But I know the risks that come with investing in stocks, and you should too. So make sure you do any due diligence you need to do before purchasing anything I talk about in this video. But otherwise, thanks for watching, and have a good rest of your day and a good weekend.